Have you ever wondered why the world's biggest investors seem calm while everyone else is either celebrating new market highs or panicking over the next headline? Because they're watching something completely different. Over the past few months, the conversation inside Wall Street has quietly changed. The excitement surrounding AI, record-breaking stock prices, and endless optimism hasn't disappeared. But underneath that excitement, the biggest asset managers in the world have been sending a much more cautious message. And when a company managing trillions of dollars starts emphasizing uncertainty, resilience, and selective investing instead of blind optimism, smart investors pay attention. This isn't about predicting an immediate market crash. It isn't about telling you to sell everything. It's about recognizing that the rules that created wealth over the last decade may not be the same rules that create wealth over the next one. Because history has a habit of rewarding the people who prepare before everyone else notices what's changing. And that's exactly what we'll uncover today. We'll break down what BlackRock is really signaling, why it matters even if you're just getting started with investing, and most importantly, how this shift could become one of the biggest opportunities of your generation if you know how to respond. But first, imagine you're driving down a highway. The sky is clear. The road is empty. Everything feels perfect. Then suddenly you see experienced drivers ahead slowing down, not because they've crashed, but because they've spotted something you can't see yet. Would you speed past them? Or would you ask yourself, what do they know that I don't? That's the question every investor should be asking right now. The warning nobody should ignore. One of the biggest mistakes new investors make is believing that markets move because of headlines. In reality, headlines usually explain what already happened. The biggest investors focus on what could happen next. That's a completely different mindset. BlackRock has repeatedly emphasized that we're entering a world where uncertainty isn't temporary, it's becoming normal. Higher interest rates, persistent geopolitical tensions, massive government debt, rapid advances in artificial intelligence, changing supply chains. None of these trends exist in isolation. They're all colliding at the same time. And when multiple powerful forces collide, markets don't become easier. They become less predictable. Here's a question. If investing were as simple as buying whatever everyone on social media was talking about, would professional investors spend billions on research? Probably not. That's because successful investing has never been about following the loudest voice. It's about understanding the environment before everyone else reacts to it. And that's exactly why this moment deserves your attention. Because while millions of investors are chasing yesterday's winners, the smartest institutions are preparing for tomorrow's risks, not out of fear, out of discipline. There's a huge difference. Fear makes people freeze. Discipline makes people prepare. And preparation has always been one of the greatest competitive advantages in investing. Think back to almost every major financial turning point. The people who came out strongest weren't the ones who perfectly predicted the future. They were the ones whose portfolios were built to survive uncertainty. That's an important distinction. Nobody, not even the biggest firms on Wall Street, knows exactly what tomorrow looks like. If someone online claims they know exactly where the market will be next month, congratulations. You've officially found either a time traveler or someone who's very confident on the internet. And history suggests it's usually the second one. The real advantage isn't certainty. It's adaptability. That's the lesson hidden beneath all the market noise. Because markets don't reward confidence. They reward good decisions made consistently over time. And that leads to an even bigger question. If uncertainty is becoming the new normal, then what exactly are the world's largest investors changing? The answer isn't as obvious as buying one stock or selling another. It's a much deeper shift in how they think about risk, opportunity, and long-term wealth. And once you understand that shift, you'll never look at investing the same way again. In the next section, we'll uncover what BlackRock's outlook is really telling investors, and why the biggest opportunity may not be where everyone is currently looking. So what exactly is the message beneath all the headlines? It's surprisingly simple. The biggest risk today isn't necessarily that the market crashes tomorrow. It's that investors become so confident in one story, they stop preparing for any other outcome. That's where things get dangerous. For the last few years, one theme has dominated almost every investing conversation: artificial intelligence. Every week, another company announces an AI breakthrough. Another stock surges. Another headline declares that we're entering a new economic revolution. And to be clear, AI is transforming industries. It could become one of the most powerful technological shifts of our lifetime. But here's the mistake inexperienced investors often make. They confuse a great technology with a guaranteed investment. History has seen this movie before. The internet changed the world. But not every internet company survived. Electric vehicles reshaped transportation, but not every EV stock rewarded investors. Innovation creates enormous wealth, yet excitement alone has never guaranteed returns. That's why sophisticated investors ask a different question. Not, what's the hottest investment? But, what assumptions is everyone making? Because markets become fragile when everyone expects the same outcome. And that's exactly where portfolio resilience comes into the picture. Instead of building a portfolio that only succeeds if everything goes perfectly, the smartest investors build one that can survive if reality turns out differently. That's a completely different philosophy. Imagine building a house. Would you only prepare for sunny days? Of course not. You strengthen the foundation because storms eventually arrive. Financial markets work the same way. Nobody knows when volatility will appear. But experienced investors assume that eventually, it will. And when it does, preparation suddenly looks a lot smarter than prediction. Now add another layer. Many stock indexes have become increasingly driven by a relatively small group of massive companies. When those companies perform well, everything feels unstoppable. Confidence rises. Fear disappears. People begin believing that markets only move in one direction. Then comes the dangerous phrase, "This time is different." Spoiler alert. History usually disagrees. Every generation believes it has finally escaped the normal cycle of markets. Every generation eventually discovers that cycles never truly disappear. They simply wear different disguises. Today's disguise happens to be AI optimism, mixed with hopes of lower interest rates and endless innovation. None of those trends are inherently bad. But when expectations become too one-sided, even good news can disappoint. That's why experienced investors don't just ask whether the future looks bright. They ask whether today's prices already assume that perfect future. Because if perfection is already priced in, there's very little room for surprises. And markets love surprising people. Now let's talk about interest rates. For years, borrowing money was incredibly cheap. That environment rewarded aggressive growth and risk-taking. But today's financial landscape is different. Money has a real cost again. Businesses must prove they can generate sustainable profits. Consumers think twice before taking on debt. Investors become more selective about where they place their capital. It's a subtle shift. But subtle shifts often create the biggest long-term consequences. Here's something most people never realize. Markets don't simply reward intelligence. They reward emotional discipline. The investor who stays calm while everyone else chases hype often finishes years ahead of the investor who constantly reacts to every headline. It's not because they're smarter. It's because they're harder to influence. That's the mindset institutions spend years developing. Not predicting every market move, but refusing to let emotions make their decisions. Ask yourself this. If your favorite investment dropped 20% tomorrow, would your first instinct be to panic? Or to ask whether the long-term story actually changed? That single question separates investors from speculators. Speculators chase excitement. Investors build conviction. And conviction only comes from understanding what you own and why you own it. Because wealth isn't usually built during moments of maximum confidence. It's built by consistently making rational decisions, while everyone else is being pulled from one emotional extreme to another. But here's where this story takes an unexpected turn. If the world's largest investors are preparing for a future defined by uncertainty rather than certainty, then the biggest opportunity may not be predicting the next winning stock at all. It may be adopting a completely different mindset before the rest of the market catches on. And that's exactly where we'll go next. Because the greatest lesson hidden inside BlackRock's outlook isn't about fear. It's about how long-term wealth is quietly created while everyone else is distracted by the noise. If there's one idea to take away from everything we've discussed, it's this. The future doesn't belong to the people who make the boldest predictions. It belongs to the people who prepare for multiple possibilities. That's the real lesson hidden beneath BlackRock's outlook. Not fear, not panic. Preparation, because every generation experiences a moment when the investing landscape changes. Sometimes it's driven by technology, sometimes by inflation, sometimes by geopolitics or interest rates. The trigger is always different, but the opportunity is remarkably consistent. The people who pause, adapt, and think long-term usually come out ahead of those who simply follow the crowd. Think about it. If building wealth were as easy as chasing whatever was trending on social media, everyone would be financially free. Yet the reality looks very different. Most people spend years jumping from one can't-miss investment to the next, hoping the next headline will change their future. Meanwhile, disciplined investors quietly keep doing the same things over and over again. They invest consistently. They diversify thoughtfully. They manage risk instead of ignoring it. And they understand something that most people don't discover until much later. Wealth is built through habits far more often than through heroic predictions. Imagine waking up tomorrow to discover that every financial headline had disappeared. No market alerts, no breaking news, no influencers claiming they've found the next 100x stock. Would your investment strategy still make sense? If the answer is no, then maybe your strategy depends too much on noise and not enough on principles. That's a question worth thinking about, because the investors who stay in the game the longest aren't the ones with perfect timing. They're the ones who build systems that don't rely on perfect timing in the first place. Markets will always rise. Markets will always fall. Optimism will eventually become fear. Fear will eventually become optimism again. The cycle repeats because human psychology repeats. That's why emotional discipline has remained one of the most valuable investing skills for over a century. Technology changes. Businesses change. Entire industries change. Human behavior, not nearly as much. And that's exactly why long-term investors continue to find opportunities while short-term traders are constantly searching for certainty that doesn't exist. So where does that leave you? If you're in your 20s, or even just starting your investing journey, you have something that many people underestimate. Time. Time is one of the few advantages that can't be bought. It allows compounding to work. It gives you room to learn from mistakes. It lets discipline outperform emotion over decades instead of days. That's why today's uncertainty shouldn't automatically scare you. It should remind you that every generation of successful investors had to navigate uncertainty of its own. The people who invested through recessions, inflation, financial crises, and technological revolutions all faced moments when the future looked unclear. Yet many of them built extraordinary wealth, not because they knew exactly what would happen next, but because they stayed focused on what they could control. And that's the mindset worth building. Control your savings, control your research, control your risk, control your emotions. The market will handle the rest. So when you hear that major institutions are emphasizing resilience and preparation, don't hear a message of hopelessness. Hear a reminder. The world will continue changing. Your job isn't to fear that change. Your job is to become the kind of investor who can thrive because of it. Because while most people spend their lives reacting to the next headline, the wealthiest investors spend theirs preparing for whatever comes next. And that difference changes everything. If you enjoyed this video, don't stop here. One of the clearest examples of changing investor behavior is happening in a place almost nobody expected. Costco. Yes, the same Costco known for bulk groceries has become part of a much bigger story involving physical gold, investor psychology, and long-term wealth preservation. If you want to understand why that trend has so many experienced investors paying attention, click the video that's now on your screen. Costco just made another massive gold move. Investors need to pay attention. I'll see you there.